But I know ICT, you use consequent encroachment on fair value gaps, and you use quadrants on regular trading hour gaps or new week opening gaps. Now, my question is, in a fair value gap, specific levels like 0.25, 0.75, and 0.5 consequent encroachment, are there different probabilities of when price action trades into your fair value gap? Let's say the wick, I know you talk about consequent encroachment, but let's say the wick respects the upper quadrant. Let's say it respects the lower quadrant. Does that change the probability of the fair value gap depending on which quadrant it goes to?
Yes, and I talked a little bit about that in the past and even today. When you're bullish, a fair value gap, you want to see that really respect the upper quadrant when it's bullish. And you don't want to see it trade the consequent encroachment or get real close to it, but don't touch it and then pull the body up to the upper quadrant or above that. That's very, very telling for bullishness. I don't like to see fair value gaps when I'm bullish trade down below with a body below the consequent encroachment. Even if the body gets real close to consequent encroachment, but it's just below it, that to me is something. If I have a large position on, or I anticipated adding more there, I won't do it. I won't load on that fair value gap. I want to see if it's going to give me a little bit, give me more evidence that you want to go higher, because that's problematic. It's usually a warning sign that I'm going to either see a shift in market structure or it's going to go into time distortion. Then I have to wait and get more information. So yes, quadrants are helpful in terms of anticipating the measure of energy that it uses when it leaves the fair value gap, but it also is a precursor to tell you if you're close to some intermediate term high forming when you're bullish. Because if it starts to fill in those fair value gaps and it pulls back down 3/4 all the way full, what it's showing you is there's a lot of distribution going back down, 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 down. And it's building in this early morning that we're going to roll over here soon, and you need to be looking for it. Fair value gaps, by nature, when they're bullish, they should stay open. You want to see everything potentially see a gap stay there. A market that's strong leaves porous price action behind it. In its wake, when it starts going higher, you want to start seeing these little tiny inefficiencies where it just simply is not willing to give a deeper discount. It's just, this is all you get. You know, you're not going to get a discount on the hottest thing in the marketplace right now. And that's my interpretation of price action. That's how I read it. That's how I teach it. Does that answer your question, or you need some amplification?
No, that was straight sauce, because I feel like a lot of traders, when they're so tunnel visioned on getting their fill, they don't put in a factor that if we're in low resistance liquidity run, those fair value gaps you want to see be left open. So they either miss their entry, or they if it goes down there, it's going to get disrespected. But what if there's you have a bullish fair value gap and there's a volume imbalance lower? I know you mark the fair value gap to the close instead of using the wicks, but would that also cause price action to go past consequent encroachment and then go to a specific level in the volume imbalance, then body up above it? Does that change anything?
It depends on where you're at in the unrealized price run. So if you're grading an unrealized price range and you're expecting it to have a significant run higher, if you're doing that in the lower half, I would just use it in terms of making sure my stop is below the volume imbalance, because it could spike down here just to entertain that and then go. But if that forms at, like, say, the consequent encroachment level or just above it, so it's like just above a premium level but still close to equilibrium, I would not be concerned about the volume imbalance, because I would expect that fair value gap stays open. I would demand that it stays open, because we're changing. Remember, as I taught today, we're going to change our expectation to, we don't want to see any give back at all, because we're at the low end to consequent encroachment. So it's kind of like a little bit of a knack. And that's the worst case scenario I could answer for, and you probably wasn't thinking about it, but I tossed it in there because that's one caveat that, based on what I've taught, it may be problematic for you. It may be like, oh, I don't know if there's a volume imbalance. Just simply make sure your stop is beyond the scope of that volume imbalance.
Wow. Yeah, no, I tend to overthink sometimes when there's a volume imbalance, and that just answered straight to my question. So, and then you're kind of leading to limit orders, right? For me, I think I don't use limit orders ever, because I feel like an edge in the market is that fair value gap. You see that respect, you see that body reaction, right? Now it could give me a little bit of a bigger stop loss, but no, you just answered everything I had. I appreciate it.
If you look at my executions, the majority of them, I'm entering on the higher end of all my PD arrays, whether it's the order block, I'm getting right in there. And you'll see I might catch a little bit of heat if I'm buying the high of the bullish fair value gap or the upper quadrant. That's where I'm aiming. That's where I'm trying to put my opportunity to enter in there. That's my first toe in the water. Bang! I'm jumping in there. I want that fill. Now, if it goes a little bit deeper and touches consequent encroachment, and it does it real quick, but leaves the wick just right at consequent encroachment, and the bodies are laying just below the upper quadrant, I'll add on that because it's telling me, yeah, I don't want to go below consequent encroachment. I don't really want to close down there. I don't even want to lay the body on that. That's when you'll see me adding and pyramiding in. But my first soiree of every entry is I'm trying to catch the high of the fair value gap or the upper quadrant. That's like my sweet spot. I don't care about anything else because I know where my stop loss is going to go before the trade even goes down here. I know where I want to see it stop. But my primary focus is how it reacts off the high of the fair value gap, which makes the highest form or boundary of it, and then the upper quadrant of that fair value gap. I want to see the bodies as they print inside that fair value gap respect, like I was teaching today. When it's staying in the upper half and it's respecting that upper quadrant, man, that's like the easiest thing in the world. It's like literally like just shooting fish in a barrel. Like they can't escape it. You can't get away from it. You're going to get it, and it allows for a very very tight stop loss, and it allows me the confidence to build the position large, build it up, build it up, build it up. Every time it gives me an opportunity to get in there and do it more in that fair value gap, bang, I'm adding more to it. And if it runs out of the fair value gap and comes back down, touches the top, I'll add to that too. So it's just a matter of knowing what I taught today, studying it in past, and then watching it live and tape reading, and you will get the confidence saying, I already know what you're going to do. I know how you're going to behave here because of where we're at in the range.
So I don't want to contradict you on this point, but when you're talking about multiple fair value gaps in an expansion, and you said in one of your videos that you want to wait for price to respect consequent encroachment to kind of identify which fair value gap you can use, but also couple other factors like if you're in lower resistance liquidity run, it could be IO-Fed or OTE. Factors change it, but if you're just taking it right at the top of that and sometimes you get a little bit of punching room there, how would you know without waiting for a body closure which fair value gap it's going to respect out of, let's say, 3 fair value gaps?
Now, let me ask you for clarity. So I'm not quite sure I understand how you framed the question. Give me a time frame for an example and kind of like flesh out what you're talking about. Like, for instance, say it's a 1 minute chart and you're anticipating a price run to buy side or sell side. What are we looking for?
So it's a 1 minute chart. We just took buy side. We broke structure to sell side. We expanded a lot lower, breaking structure on the intermediate time frame as well. And that expansion, that volatile expansion, left 3 open fair value gaps. Now, price action is slowing down, but it hasn't taken any sell side liquidity. And there's 3 fair value gaps that people are looking to enter on. And I know you said in the previous video that to identify which fair value gap you can take, you can see which one respects consequent encroachment. But to be able to identify which fair value gap it's going to, the one in the premium, equilibrium, or discount, how do you do that without waiting for a body closure?
Okay. So I will counsel you to go and look at model 2022. I covered multiple fair value gaps, and when they have 2 and you gave me 3, so I'll just say, okay, we're going to use the same thing here. What's the highest fair value gap? If the market structure really did, in fact, shift lower, and it really is going to go lower, and it wants to go lower, and you're going to be on side if you take a short, your stop loss has to be at least anchored to the potential of it running up to the highest fair value gap, but leaving it open so that way it affords you to see a breakaway gap. If it's just 2 fair value gaps, the same thing there. As I taught in Model 2022, it can shoot up into the upper, higher second fair value gap, but your stop has to be respecting that higher fair value gap. But I'm going to enter in the lower one, and if it punches up in that second higher one, I'll add and pyramid into that. I have no problem doing an addition under a little bit of water. If I know that the structure is there and it's just being tossed up a short-term premium before it dives lower, I'm accepting the fact if I get stopped out, that's a loss I'll eat. I don't have a fear of being wrong. If I get stopped out and it rolls over again and starts moving in my favor, then I'll just take a bearish order block because there's up close candles that are right there. So what I'll just simply do is wait for it to tap the lowest opening of the two up close candles that used to run up into that and stop me out. I'll just get right back on, and there it is. I'll just do it with half the position, and I'll make all the money back and more.
Okay. Well, I mean that makes sense. Basically, what you're saying is, it depends on to narrative,
Yes.
and what happened in the markets.
What measure of conviction do you have about? How much do you trust your analysis about whether or not it's really market structure shift, or are you just throwing darts? If you're not really strongly convicted about the idea that this really has posted everything that I would expect as a market structure shift and it's bearish, there's really a lot of other intermarket relationships that supports this idea of me seeing lower prices on this. And inversely, correlated things like the dollar index, it should be going the opposite direction. Seasonal tendencies being in line with what you expect. Just a whole slew of things that could be piled on top of it as a confluence or a confirmation, increasing the validity to what it is you expect. It should reduce all of the, I guess, immediate trepidation about taking it and just simply saying, okay, I just need a wider stop loss. If I see three fair value gaps, or if I see two fair value gaps, I just simply say, okay, I have to trade with smaller size to afford this trade because I have to account for that higher fair value gap that could get traded up into as an institutional order flow entry drill and not complete closure, making it a breakaway gap.
Okay, so it's not about being right on the exact entry. It's about having the right stop loss placement coupled to the narrative.
Multiple fair value gaps makes the expression in algebra. The answer you're seeking is the stop loss placement, not the finest entry. When it's one single fair value gap, the focus is primarily the position entry, and the stop loss is irrelevant because it's easy. It's just above the fair value gap.
Beautiful. Thank you, ICT.
You're welcome.